Today, we're diving into Chapter 19, which focuses on spoilage, rework, and scrap. These are critical concepts in manufacturing because they directly affect costs and efficiency. Spoilage refers to units that are damaged beyond use, while rework involves fixing defective products so they meet quality standards. Scrap, on the other hand, includes materials or products that can't be reused or sold. Understanding how to account for these manufacturing defects helps us manage expenses and improve overall production processes. This chapter will guide us through the accounting treatments and implications for each category. Spoilage refers to any production output that doesn't meet the required specifications and can't be economically fixed. Essentially, these are defective units that represent lost output because they often have to be discarded or sold at a significantly reduced value, rather than being reworked into acceptable products. Understanding spoilage is important because it directly impacts a company's efficiency and profitability, highlighting areas where production processes may need improvement. This concept is closely related to rework and scrap, which also involve managing defective or unusable products. When talking about spoilage, it's important to distinguish between normal and abnormal types. Normal spoilage is what we expect to happen during efficient production. It's considered just part of the cost of good units and is factored into process or job costing. On the other hand, abnormal spoilage is not expected. It usually results from mistakes, equipment breakdowns, or poor quality materials. This kind of spoilage is treated differently because it represents avoidable loss, so it's charged separately. Essentially, the key difference between normal and abnormal spoilage is whether the loss is anticipated or something that could have been prevented. This concept is vital for accurate cost accounting and managing production efficiency. Now, let's talk about normal spoilage and how it's handled in cost accounting. Normal spoilage refers to the expected amount of defective units produced even when operations are running efficiently. This spoilage is considered an unavoidable part of the manufacturing process, not caused by mistakes or equipment failures. Because it's expected, the cost associated with normal spoilage is treated as part of the product cost. This means it's included in the unit cost of the good products being made. Depending on when the inspection happens, the cost of normal spoilage is either assigned to the good units or to the process itself. Understanding this helps us accurately allocate costs and manage our production processes effectively. Abnormal spoilage refers to the amount of spoilage that exceeds what we would expect under normal, efficient operating conditions. It's important to understand that this type of spoilage is not considered a regular part of production costs. Instead, it is treated as a separate loss during the accounting period in which it occurs. This distinction helps us identify inefficiencies and take corrective actions. Alongside spoilage, there are related concepts like rework and scrap, which also affect production quality and costs. Understanding abnormal spoilage is crucial for maintaining cost control and improving overall manufacturing efficiency. When we talk about rework, we're referring to the process of correcting a defective unit so that it meets the required specifications. This is an important distinction because, unlike spoilage where the defective unit is discarded and considered a loss, rework focuses on repairing the item to make it usable. Essentially, rework helps reduce waste by fixing problems rather than throwing products away. This concept ties directly into the broader understanding of spoilage, rework, and scrap, all of which are critical for managing quality and costs in production. It's essential to grasp that rework involves additional effort and resources to bring a defective product back up to standard instead of simply discarding it. Now, let's talk about scrap. Scrap refers to materials that are left over from the production process. These materials usually have some minor sales value, meaning they can be sold or reused to some extent. It's important to note that, unlike spoilage, scrap is not defective. Instead, scrap is residual material that remains after production. So while spoilage involves faulty or unusable products, scrap consists of leftover materials that still hold some usefulness. Understanding this distinction helps us manage production resources more effectively. Here, we're looking at how spoilage is treated under two main costing methods, the weighted average method and the FIFO method. Starting with the weighted average method, we combine the beginning inventory with the current period units and costs to get an overall average. Normal spoilage is included in the calculation of equivalent units of good output, which means the spoilage cost is spread out across both the units completed and those still in ending work in process. On the other hand, abnormal spoilage is handled differently. It's charged separately as a period loss, so it doesn't affect the cost per unit. Switching to the FIFO method, the approach is a bit different. Here, we keep the beginning inventory work separate from the current period production. The equivalent units are computed only using the work done during the current period. Normal spoilage is assigned depending on where the inspection takes place in the process. Like in the weighted average method, abnormal spoilage is treated as a loss but is expensed separately from the transferred or ending units. Overall, understanding these distinctions is crucial for accurate process costing, especially when accounting for spoilage, rework, and scrap. Each method impacts how we assign costs and measure efficiency in production. Here, we're diving into the key steps of the weighted average method in process costing. First, we combine units by adding the beginning inventory units to the units started during the period. This gives us a total unit count to work with. Next, we compute equivalent units, which measures the completed output plus the work done on ending inventory. Then, we average total costs by pulling together beginning inventory costs with the current manufacturing costs. Finally, we assign cost per equivalent unit by applying this average rate to the completed units, any spoilage, rework, and the ending inventory. It's important to remember that this method blends beginning work in process with current period costs in units, giving us a smooth, averaged approach to cost calculation. This process helps simplify cost tracking in continuous production environments. Now, let's focus on how the FIFO method in process costing handles spoilage. First, we track spoilage strictly within the current period's work. This means any spoilage is associated only with the units processed during this accounting period, not with beginning inventory. To do that effectively, we separate beginning inventory so prior period costs remain distinct from current period units. Next, we compute current equivalent units by measuring only the work added during this period, which provides an accurate reflection of production effort. After that, we assign the current period cost per equivalent unit by dividing the current costs by these current equivalent units. This allows us to value the output precisely based on recent costs. Finally, spoilage is allocated based on when it occurs. Normal spoilage gets absorbed by the good units, while abnormal spoilage is charged separately as a loss. This approach ensures clear, fair accounting for spoilage, rework, and scrap in process costing using FIFO. Here we see how spoilage is accounted for at different stages of completion in process costing. At 0%, input has been added but almost no conversion cost is assigned yet. When spoilage occurs at 25% completion, only a quarter of the conversion cost is included in the spoilage. At 50%, half of the conversion cost is carried forward to the spoiled units. Moving to 75%, most of the conversion costs have already been embedded by that point. Finally, at 100%, both the full material and conversion costs are assigned before spoilage is recognized. The key takeaway here is that the later spoilage is detected in the production process, the more prior conversion costs it carries with it. This impacts how we allocate costs for spoilage, rework, and scrap during process costing. When we talk about spoilage in job costing, it's important to distinguish between normal and abnormal spoilage. Normal spoilage is considered an expected part of the manufacturing process. Its cost is either charged to manufacturing overhead or directly assigned to the specific jobs affected. If the spoilage is tied to a particular job, we assign the cost to that job. But if it's common across multiple jobs, we allocate it using an overhead allocation base. This approach treats normal spoilage as a regular production cost. On the other hand, abnormal spoilage is different. It's unexpected and usually indicates inefficiency or errors. Because of this, its cost is not assigned to good units. Instead, we record abnormal spoilage as a separate period expense. There's no allocation to jobs or overhead pools, we isolate it to better evaluate performance and identify issues. So, the key takeaway here is understanding whether spoilage is expected or not, because that determines how its cost is recorded and allocated in job costing. Normal spoilage gets absorbed as part of production costs, while abnormal spoilage stands out as a separate loss to flag potential problems. Here we have the details for job 415, with materials costing $18,000, labor at $9,000, and overhead at $6,300. When it comes to accounting treatment, all defect-related costs are accumulated in work in process for this specific job. If spoilage is considered normal and specific to the job, we charge those costs directly to job 415. In cases where rework is necessary, any additional materials and labor required for the rework are also added back to this job. However, if spoilage is abnormal, it must be removed from the job's costs and recorded separately as a loss. This approach ensures accurate tracking since the defective custom order is tied to one specific job, allowing us to follow that job's unique cost details closely. When we talk about rework in job costing, it's important to distinguish between normal rework and abnormal rework. Normal rework refers to the routine costs we expect to incur when defects happen during production. These costs aren't seen as losses, instead, they're assigned back to production. If we can trace the rework cost to a specific job, we charge that job directly. However, if the rework is common across multiple jobs, we allocate these costs as manufacturing overhead and spread them across all output. On the other hand, abnormal rework is quite different. It's an unusual cost that results from non-routine mistakes or inefficiencies. Unlike normal rework, we don't include these costs in inventory or treat them as normal product costs. Instead, we record them separately as a loss. It's essential to highlight abnormal rework to management because it signals a problem in performance, rather than a typical cost of manufacturing. So, the key takeaway here is that how we account for rework depends on whether it's expected or exceptional, and this distinction helps us manage costs and address production issues appropriately. When dealing with rework costs, the accounting process follows a typical journal entry structure. On the debit side, we charge the account responsible for the defect, which could vary. It might be a specific job, manufacturing overhead if the defect affects all jobs, or a particular department. This ensures the cost is assigned appropriately based on who caused the issue. On the credit side, we reflect the resources used to fix the defective units, such as materials, wages, and overhead. These credits capture the extra inputs consumed during the rework process. It's important to distinguish between normal and abnormal rework. Normal rework costs are included in product costs and charged accordingly. However, abnormal rework should not be buried within product costs. Instead, it must be recorded separately, often as a period loss or in an abnormal cost account. This separation helps in accurately assessing the efficiency and quality control within the operation. The key concept here is that the debit entry changes depending on who is responsible for the defect, while the credit side consistently records the resources used to correct the defect. This clear accounting treatment aids in precise cost tracking and management decision-making. Now, let's talk about accounting for scrap in manufacturing. Scrap can originate from normal operations or abnormal operations, and it's important to treat these differently. Scrap from normal operations is expected and can be used to reduce manufacturing overhead or the cost of goods manufactured, which helps lower overall expenses. On the other hand, scrap from abnormal operations isn't part of regular production and should be recognized separately as a loss during the period it occurs. This loss is reported outside of normal production costs to reflect that it's an unusual event. When scrap is sold, the cash received is recorded and credited to the appropriate account, whether that's a designated scrap account, overhead, or inventory-related account. Properly accounting for spoilage, rework, and scrap ensures accurate financial reporting and helps identify areas for cost control. Now, let's talk about scrap revenue recognition and the two main approaches to handling it. First, we have immediate recognition. This means that scrap revenue is recorded at the time the scrap is sold. Typically, this is accounted for as other income or used to reduce overhead costs. It's straightforward and reflects the revenue as it comes in. On the other hand, there's deferred recognition. This approach is used when the scrap value is both expected and significant. Instead of waiting until the scrap is sold, we estimate its value in advance and reduce the production cost accordingly. By doing this, the costs are more accurately matched with the production period. Both methods have their uses depending on the significance and predictability of the scrap value, and it's important to choose the right approach to ensure accurate financial reporting. Let's dive into the key concepts of spoilage, rework, and scrap and how they affect inventory and costs. Starting with spoilage, this refers to units that fail to meet quality standards and cannot be fixed or made acceptable. Spoilage costs can be classified as either normal or abnormal, and this distinction is important because it impacts how the cost is treated in accounting. Spoilage reduces the amount of good output, which in turn increases the unit cost of production. Next, we have rework. Rework involves correcting defective units so they can be sold. Unlike spoilage, rework costs are added to the production cost, and these costs are often charged to specific jobs. Successfully reworked units remain in inventory after correction, so they don't represent a total loss like spoilage. Finally, scrap is the material left over from production that has minor sales value. Scrap does not become part of the finished goods inventory. Instead, it's recorded either as other income or as a reduction in manufacturing costs. Understanding the differences between spoilage, rework, and scrap is crucial because they are treated differently from an accounting standpoint, which affects how we assess production efficiency and cost management. Here we focus on how to handle spoilage and process costing by first determining whether the spoilage is normal or abnormal. Normal spoilage is considered an expected part of the production process and is absorbed into the unit cost, meaning it's treated as a regular cost of making the product. On the other hand, abnormal spoilage goes beyond what is expected and is therefore charged separately as a loss, so it's not included in the cost of good units. This decision framework helps us accurately assign costs and maintain clear financial records, ensuring we differentiate between what's a routine part of production and what represents an inefficiency or problem. When dealing with spoilage, one common mistake is treating all spoilage the same. It's important to distinguish between normal spoilage, which is considered a part of the production cost, and abnormal spoilage, which is treated as a separate loss. Another frequent pitfall is ignoring the stage of completion when spoilage occurs. This can significantly impact the calculation of equivalent units and how costs are assigned. People also sometimes mix the rules of process costing with job costing, which can lead to errors in handling spoilage, rework, and scrap. The way these are traced and recorded varies depending on the costing system you're using, so it's crucial to apply the correct method. Another oversight is neglecting the scrap value. Scrap proceeds might either reduce the overall production cost or be recognized as separate income, depending on the company's accounting policy, and this choice affects financial reporting. So, the key takeaway is to carefully classify spoilage, consider where and how it occurs, apply the appropriate costing rules, and handle scrap proceeds according to the established policy to avoid these common pitfalls. In this manufacturing scenario for Delta Components, we started May with 10,000 units in the shaping process. By the end of the period, 9,200 of these units were completed successfully as good products. Additionally, we still had 500 units in ending work in process, which are about 60% through the conversion process. An important aspect to note is the spoilage detail. Out of the total units, 300 failed inspection when they reached about 80% completion. Within this spoilage, 200 units are classified as normal spoilage, meaning they are expected and factored into the process. However, 100 units are considered abnormal spoilage, indicating a problem that could potentially be addressed to improve efficiency. This case study highlights the critical differences between normal and abnormal spoilage, as well as their impact on production costing and process management. Understanding these elements helps us better control quality and optimize the manufacturing process. Here we have a breakdown of how to allocate costs using weighted average process costing when normal spoilage is involved. First, we started with 10,000 units. Out of these, 9,200 units were completed and considered good, while 300 units were classified as normal spoilage, and there were 500 units still in ending work in process. To calculate equivalent units, we add the good units completed, which is 9,200, to the ending work in process units, totaling 500. This gives us 9,700 equivalent units. Next, we move on to the cost per equivalent unit. We begin with the beginning cost of $4,000 and add the manufacturing costs added during the period, which were $44,500. This brings the total cost to $48,500. When we divide this total cost by the 9,700 equivalent units, we get a cost per equivalent unit of $5. Now for the cost allocation. The completed good units are assigned a cost of $9,200 multiplied by $5, resulting in $46,000. The ending work in process units are valued at $500 multiplied by $5, giving $2,500. The normal spoilage cost is absorbed by the completed units, so it's included in the cost of good units. In total, the assigned costs add up to the full $48,500. This example helps illustrate how normal spoilage is handled within the weighted average method. Essentially, its cost is spread over the completed good units rather than recorded separately. This approach ensures costs are allocated fairly and accurately in process costing systems. Let's break down some important concepts related to spoilage, rework, and scrap. Spoilage refers to defective output that simply can't be fixed or turned into good units. In contrast, rework is about restoring defective units so they meet quality standards again. Then, there's scrap, which consists of leftover material that has limited but still measurable value. It's important to differentiate between normal and abnormal spoilage. Normal spoilage is expected during production and is generally accounted for as part of the manufacturing cost. Abnormal spoilage, however, is unexpected and is charged directly as a loss, impacting profitability. How we treat these costs depends on several factors, including the costing method used, the stage of completion in the production process, and the overall production setting. Understanding these distinctions helps in accurate cost allocation and better decision-making in managing production quality and efficiency. To wrap up, it's important to understand the different types of manufacturing defect costs: spoilage, rework, and scrap. Spoilage refers to products that don't meet quality standards and can't be repaired. Rework involves correcting defective products so they meet specifications. Scrap represents materials or products that are discarded completely. Accurately accounting for these costs is crucial because it impacts product costing, how we measure performance, and ultimately, how we control costs in the manufacturing process. Keeping a clear handle on spoilage, rework, and scrap allows us to identify areas for improvement and maintain efficiency.